Hello investors, welcome to Simpli Stocks. For today's video, I have brought for you three interesting jewelry businesses that have delivered fantastic results in this June Q1 quarter, and they continue to look quite promising for the future as well. Today's video will be quite special because all three of these businesses are unique in their own ways. Even after a massive rally, the first one continues to look quite attractive and institutional participation is increasing in it. The second stock which we will discuss today has shown a very strong recovery after a dull quarter in March. And the third one is growing fast on a small base, sitting in a fast growing category as well. So without wasting any time, let's quickly get started. Now, the first on the list I'll discuss today is my favorite, Sky Gold and Diamonds. Sky Gold has performed remarkably well since the March lows and is currently trading at an all-time high. You might remember that around the same time, back in mid-February, I had made a dedicated video on Sky Gold saying that the business had corrected for no valid reason and its long-term fundamentals were completely intact. And it has done very well since then. And now in Q1, their performance or their results have been very, very good. But before jumping straight to the numbers, I'll briefly summarize Sky Gold's business model just in case if any of you are new to our channel. So Sky Gold and Diamonds is a B2B jewelry manufacturer. They design and manufacture jewelry for other jewelry retailers or companies in the market. For example, all major jewelers like Kalyan, Malabar, Reliance Jewels, and also Thangamile, which is a very well-known name in Tamil Nadu, along with Damas, which is famous in Middle East. So all of them are their customers. Now let us look at their results. So you will see that in the 3 months from April to June, their sales grew by massive 78% year on year to reach more than 2,000 crore rupees. Profit has also shown strong growth. Gross profit grew by 105% and EBITDA saw a good growth of 120%. PAT growth was even better at 141%, meaning their net profit has nearly become 2.5 times compared to the last year. And company has generated a net profit of 105 crores. Plus, they have benefited significantly from operating leverage as well. And on top of that, margins are also expanding. You will see here. And we will discuss that in more detail ahead. So overall, we can say that Sky Gold has delivered very strong results across all the metrics. Here, you will also notice that net profit margin has now reached 5.2%, which is very good progress. Now, you might say that this profit margin is a bit low, but see, what happens is in the jewelry sector, profit margins are naturally low because the item on which the margin is calculated, which is gold, it is itself a very expensive product. Therefore, understanding the sector dynamics is also very important. You cannot simply reject it by calling it a low margin business. Now, if you ask me why I am so excited after seeing these results, because this 5.2% margin, this used to be their long-term PAT guidance. Their management used to state that they had a target of achieving 5.25% net profit margin by 2030, which they have practically almost achieved right now. So their performance has been very good. Plus, it stands out for one more reason is that Sky Gold generated 30 crore rupees of cash in this quarter. That is cash profit in this quarter. So they were profitable before as well. But earlier, all the profits used to go right back into the business for firstly reinvestment and then inventory. Since the product they deal in is gold, the inventory itself is expensive. But this is the first quarter where even after fulfilling all their inventory requirements, they still have 30 crore rupees of surplus profit left over. So that is also a milestone. A significant contributor to this is the AGM or advanced gold model. Under this model, what happens is the client provides gold to them on a job work basis, meaning the client says like, here is 5 grams of gold, make jewelry or chain out of it and give it back to us. So Sky Gold does not have to spend its own money to buy gold. And you will see that AGM's contribution to their sales has reached 17%, whereas their annual guidance was 15%. Sky Gold is working on this model with top corporate clients like Thangamile, Kalyan, Reliance Jewels, and this has a very positive impact on their working capital days. AGM also helps to improve margins because job work revenue is purely a sale of service, which flows straight through the P&L to improve overall margins. Apart from this, they are also gaining business by bringing designs for their clients in lower caratage jewelry and also studded jewelry segments, which offer better making charges and hence better margins. Now, even though they had earlier given guidance for 35% sales growth for the near to long term, they are currently running much ahead of that. So I'll say, and not just in terms of guidance, also in terms of other things like margins and all. So I'll say there is no point in going through all those old guidances as such, but I feel that they can easily do at least 9,000 crore in sales in this year, because they have already clocked 2,000 crore in the June quarter, which is typically the weakest quarter for the jewelry sector. So if you assume even a 5% PAT margin on that, then their estimated annual profit comes to around 450 crore rupees. And that is entirely possible since they made 105 crores of profit in Q1 alone. So even though Sky Gold has rallied so much, we are seeing that. But if you look at this year's estimated profits, the forward PE is still very attractive. A business of this size with a market cap of 10 to 12,000 crores is available at a 1-year forward PE of 26 to 27. Plus, their long-term growth guidance also remains very strong to grow at 30 to 35% CAGR. So all in all, I will say even right now, the valuation is good. And also one more thing from Sky Gold's con call that I really loved is that their target, the long-term target of 18,000 to 19,000 crore in sales by 2030, which they have given. So that target does not even include AGM sales. And when I heard this, I honestly could not believe it. And you must understand this carefully because it is important. Right now, 17% of their sales come from AGM, and their target that they want to take it up to 30% by FY30. But because that entire portion is a high margin service revenue, they have not included it in the sales guidance. So if you do the math yourself, the profit growth in this business will turn out to be well over 50% CAGR. So overall, Sky Gold remains a solid business that you can look into yourself. Furthermore, what is happening is institutionalization is playing out in this company. This means the company has grown large enough that DIIs and FIIs are comfortably entering in it and increasing their stakes. Like over the past year or so, you will see here that institutional holding has doubled. Usually, what you will see is that you will find very few small cap companies attract institutional investors because they lack sufficient liquidity. But Sky Gold is now big enough in size, plus it is still growing fast. So because of this, this business can also see re-rating because institutions are taking position in this company. Now see, Sky Gold is doing well right now and the results are great. But there is no guarantee whether it will remain good for, good after 3 or 6 months or not. That you have to keep tracking. I like Sky Gold because their management has consistently executed on their plans. But there is no guarantee that it will always perform well. Like everyone knows that long-term investing is the way to go. But think about it. You will only hold a company for the long term if it keeps delivering great results every single quarter, every single year, right? Otherwise, there have been long-term investors in companies like Vodafone Idea and Reliance Power as well. But at the same time, for a normal retail investor, it is not possible to invest so much time in picking good businesses out of thousands of stocks and then studying them so deeply. That is why we have created a personal WhatsApp community for serious investors where we closely track more than 100 good businesses for you. And this is across the whole market universe, from large, mid caps to many small cap and even micro cap businesses. I discuss everything in detail, like their business model, valuation, risk factors, how are their results, everything is discussed in detail. Here, I also share my portfolio and I clear all your doubts on a one-to-one basis. But remember, this is a paid community and there are two plans in this: 6,000 rupees for 6 months and 10,000 rupees for a full year plan. In the 6-month plan, your monthly cost will average to just 1,000 rupees. And in the full year plan, your monthly rate will be just 850 rupees. So if you are interested, you can send a WhatsApp message on this number, or else you can also contact us and join this community through the link given in the description below. Moving forward, let us look at PN Gadgil Jewellers on number 2. So Gadgil had disappointed quite a bit in the March Q4 quarter, but the business has gotten back on track in Q1. Now, as an investor, you have to learn to keep a flexible mindset, meaning, let us say, if you had to exit a business due to certain issues, but later you see that those things are improving over there. So you should drop your past judgments and look at it from a fresh perspective. So keeping that in mind, let us move ahead. Now, as you would all know, PNG is a jewelry retailer, just like Kalyan and Tanishq. Until now, PNG has primarily been based out of Maharashtra, but now they are expanding into Madhya Pradesh, Uttar Pradesh, Gurgaon, Bihar, and other regions as well. They now have a total of 78 stores across 36 cities. From here, they have a target to open about 37 stores this year and another 37 stores in each of the next 2 financial years, bringing their total store count to about 177 by March 2029. Now, out of these, 113 will be their flagship large format Gadgil stores, and 64 stores will be under their lifestyle brand for lightweight, low ticket jewelry. Now, let us look at their results. So, you will see here that in Q1, the company sales grew by 41% year on year to cross 2,400 crores, with retail sales growing by 56%. Gross profit grew by a healthy 42%, while EBITDA and net profit grew by 57% and 52% respectively. Performance in the franchisee and e-commerce segments was a bit dull, but that is not a major issue yet because firstly, franchisee stores are relatively new for them. So they are working on improving, let us say, efficiency over there, improving performance over there. And as for the e-commerce, they have reduced their focus on gold bars and coin sales because those carry lower margins. So that is why the growth appears to be lower over there. But going forward, we should see recovery happening in these two segments as well. One more thing, as you can see in the P&L statement, that the margin issues that they faced last quarter, they have now been resolved. You might remember that in the March quarter, Gadgil had sold more gold bars and coins to push sales. Alongside that, they ran Foundation Day and Gratitude Day campaigns, offering discounts on making charges and also promotional offers. So because of that, you will see here that gross margin had dropped to 9.7%, which the investor community obviously did not like. But gross margin has again bounced back to 13.2%. While year-on-year gross margin might look similar, last year they told that they did not have that much inventory hedged. Consequently, last year they benefit from inventory gains due to rising gold prices. So if you adjust for that, there has been actually an improvement of about 0.4 to 0.5% in gross margins, driven by an increase in studded jewelry sales. Now, their guidance is that gross margin going forward will stay within the 13 to 14% band this year. EBITDA margin came in at 8%, and the net profit margin for the quarter was 4.4%. So these are good results, and I'll say confidence in Gadgil is slowly building, coming back or building back up. Like the management has given guidance for around 13,500 crore in sales for this year, which translates to about 25% growth. At the same time, their EBITDA is to, their target is to maintain EBITDA margins in the 7 to 7.5% range, and PAT margin should stay around 4 to 4.2%. And what did they actually deliver in Q1? So 40% top line growth. Plus, company is also running slightly ahead in terms of margins, though management has explained that Q1 tends to be lighter from an expansion standpoint. So lower expenses, that's why margins are better. Moving forward, profit margins will likely settle around their original guidance of 4 to 4.2%, but I'll say that is still a good performance. In retail sales, the stud ratio or the sale of diamond and gemstone jewelry, so that has also increased from 9.9 to 10.9%. And this is good because studded jewelry carries better margins. And for their stores in regions like UP, the stud ratio management told is already running at 15 to 18%. So that is also a positive sign because right now only about 3% of their sales come from these stores which are outside Maharashtra. But as they open more stores out of their core region Maharashtra, so we should see margin expansion because that will drive more of studded sales. Similarly, the contribution of jewelry to total sales has increased to 78%, while bullion stands at 22%. And if you recall, the contribution of gold bars and coins had spiked to 40% in the March quarter. So that had dragged down margins, but right now we are seeing that is also improving. So everything is looking like it is getting back on track. If there are no further surprises ahead and they continue to execute well like they did in Q1, so Gadgil should turn out to be a good business. Valuation wise also, Gadgil is currently trading at a PE of about just 20 right now. And given their guidance of 13,500 crore in sales and 4.2% net profit margin for this year, the estimated profit for FY27 comes out to around 550 to 570, 575 crores. So making the forward PE even lower at 15 to 16. So this is definitely a worth studying business, and you can track it independently. Now, the third and final jewelry business which we will discuss today is PNGS Reva Diamond. This company belongs to the PN Gadgil and Sons Group. Please do not confuse this with PN Gadgil Jewelers, as both are entirely separate entities. One is PN Gadgil Jewelers, which we just covered. The other one is PN Gadgil and Sons. And even within the PN Gadgil and Sons group, there are two companies listed in the market. One is PNGS Reva Diamond, which, as the name suggests, deals in diamonds, and the other one is its sister company PNGS Gargi Fashion Jewelry, which is into silver jewelry. Now, PNGS Reva Diamond operates SIS, that is shop-in-shop stores within their legacy Gadgil and Sons stores. If you have visited, let us say, Malabar, Kalyan, or Titan jewelry stores, you might have noticed that how floors or sections are divided. There as a separate section for diamond jewelry, separate one is for silver, and so on. So they have also separated their diamond business in a similar fashion and got it listed, and also raised capital from the market through an IPO for its expansion. Their target now is to open dedicated, full-fledged exclusive outlets and stores for diamond jewelry in addition to these SIS units. Just like PN Gadgil, they are also primarily based in Maharashtra, and currently they have about 34 SIS stores and 3 separate independent stores. Now, out of the IPO proceeds, they have a plan to open a total of 15 stores, 9 of which are opening this year and 6 next year. And out of the 9 targeted for this year, they have already opened 2 so far. Since PNGS Reva is a very small company, so you have to carefully track when their stores become profitable and what the inventory turnover looks like in these new stores. Like, their target is that stores which are opened within their home state of Maharashtra, so they will reach break-even point within a year, while stores outside Maharashtra will take a little bit longer, about 15 to 18 months to turn profitable. Now, earlier I used to have a negative opinion regarding PNGS, and I will also admit that I have somewhat misinformed you all by sharing my view in the Q4 business update video. I viewed, or I will say I thought, that lab-grown diamond players, LGD players, are a risk to PNGS and other players. But their management explained very well in the recent con call that they mainly deal in jewelry which has very small sized diamonds. As you go lower in diamond size or caratage, the price difference between LGDs and natural diamonds that shrinks significantly. The main cost ends up being of the labor. So whether you polish and finish a lab-grown diamond or a natural diamond, the staff cost you pay is practically the same. And 95% of the jewelry or diamond jewelry sold in India consists of low caratage diamonds. So we can say that LGDs are actually creating a completely separate higher caratage market, and the segment where players like Bluestone and Reva operate, so that segment faces no as such threat from these other lab grown players. In fact, if you look at the numbers of Bluestone, Kalyan and Tanish, the sales of diamond and studded jewelry are growing quite fast. And I am personally more bullish on Bluestone, which I had covered in the previous video on our channel. But if you want, you can choose to play either of them, PNGS Reva or Bluestone, whichever you prefer. However, one risk is that as they open more of their own standalone stores, we might get to see pressure on the margins. Right now, many of their expenses get shared with obviously the main store, and management mentioned that marketing costs are also going to increase going forward because they are opening exclusive stores. In SIS stores, sales are driven by upselling to regular Gadgil and Sons customers, but exclusive brand outlets will obviously need independent marketing support, and here they are also planning to bring on a brand ambassador later on. So that is also there. So marketing costs are going to increase. So that is for sure. Now, let us quickly go through the results since the video is getting a bit lengthy. So here you will see that their sales grew by a massive 119% compared to the last year. Out of this, they recorded 50% same store sales growth, meaning the sales of older SIS stores grew by 50% year on year, while the rest of the sales came from new SIS stores. And obviously, with such a strong sales growth, they benefited from the operating leverage. You can see how nicely their margins have expanded. EBITDA margin jumped from 22% straight to 29%. As a result, EBITDA grew by incredible 193% to become nearly 3 times in value. And profit grew by, mind you, 265%, or it basically became almost 3.5 times to reach 27 crore mark. But management also pointed out that PAT margin will obviously come under pressure by 2 to 3 percentage points going forward. So you should you need to evaluate this business very closely on a quarter-on-quarter basis. Growth is definitely strong, but you have to make sure that there is firstly there is not any sudden slowdown in sales, so that will hurt the sentiment, plus a very steep drop in margins. But even with that, I will say PNGS Reva's valuation looks quite attractive. In the June quarter, which is the weakest quarter for the industry, they managed to generate 27 crores of profit on sales of 118 crores. So let us say even if some margin compression does happen over the course of the year, I estimate that they will be able to make around 27 into 4, about 108 to 110 crores in profit for this year. And based on that, the forward PE still comes out to under 20, plus base is small, so obviously growth can happen fast. The only catch is that while top line growth is bound to come during such heavy expansion, but we can't be entirely sure how much that will translate into bottom line growth, because marketing and other expenses are going to go up. But anyways, this is a good business that you can explore gradually. Now, in the end, my humble request, if you like this video, please make sure to hit the like button. You can also subscribe to our channel, Simpli Stocks. In the coming time, we will be bringing you commentary on many more such good businesses. So with this, I will see you in the next video. Happy investing.